investing your retirement money, don't make these mistakes. These are really common mistakes that I see made all the time by investors, professionals and amateurs. Let's take a look at this study right here to walk you through what I see happening. Now, if we look at this study, it was Brinson, Hood v. Bauer. They were three academics. They were studying pension plans. They said the biggest, the brightest, the most educated investors, what drives returns? Now remember, we invest for returns, so if we know what's driving returns, that's probably an important thing to pay attention to. What we see right here is when these pensions engaged in market timing, it had a little impact on returns. And when they had other factors, and they had stock selection. So those were three things that they looked at. But the dirty little secret about this particular study is that when they engaged in these processes of trying to figure out which areas of the market to be in and when to be in them, or which stocks to hold, they actually hurt returns. They lowered returns and increased risk when they engaged in that. They said, so what did really drive returns? What really was important? And the answer was asset allocation. One time they did the study, it was 91%, another time it was 94%. So that is typically what you really want to focus on, is how much in large companies, how much in small, how much in value, growth in US and international, and stocks versus bonds. That's the important thing to focus on as an investor. Well, what's the evidence of this? Well, if we look at stock picking studies, we see that no matter what area of the market that we invest in, looking back through history, this particular study shows that professional managers trying to determine which companies are better than others actually tend to hurt returns and not help them, using their brilliance and their skill in determining which companies they ought to be focused on. If we look at this right here, you see, if we look at stock picking, you'll see that fund companies will engage in turnover. So let's say that I have a fund with 100% turnover. It means 100% of the stocks are different from one year to the next. That would be 100% turnover. Well, you would think that the fund would vary in terms of how it performs versus the market, with that much buying and selling and that much change in the stocks that are held. Well, you see with this fund, you'll see that some years the turnover is 47%, and it's 203%, and 193%, and 213% here, and 199% there, and 214 there, and so on and so forth. That's a lot of buying and selling. They're changing stocks more often than some people change their underwear, is what we're seeing right here. So you would think that the fund and the market would not look like each other, but this chart shows you different. The yellow line is the market. The blue line is the fund. And you notice that the blue line is under the yellow line. In other words, their efforts are actually hurting returns. But notice this. When the market goes up, the fund goes up. When the market goes down, the fund goes down. Market goes up, the fund goes up, and so on and so forth back through history. So we see what's driving the bus here is the asset mix, or the asset allocation. Now, some people hear this stuff and they go, well, yeah, Paul, stock picking, market timing, forget about it. I'll just buy a total market fund. That's what I'll do. And you run into another problem here. And that problem is diversification, because it's cap weighted is what we call that. You notice that most of the money is in the very biggest of companies. Almost nothing is in small companies. So even though we own 3,700 stocks, you really don't have that great a diversification because of that. Now, let's say if we compare that to the S&P 500, 500 companies versus 3,600 companies or so. We can take two indexes, the S&P 500 and what's called the CRSP 1 through 10, which is the whole market, and you notice something really interesting. All the way back to 1970, that they move very much in tandem with each other. So you can see that even though one owns a lot more stocks than the other, the diversification really isn't helping because of that capitalization weighting. Now, this is real diversification. We're owning big companies and small and value and growth and all of that. And I want you to see another mistake that investors make right here. They tend to do this. They tend to go, hey, what had the best performance? And they're looking through the different funds, and they're looking at the last 10 years, and you're 1985, you're trying to choose which fund to buy. You might be really focused on a fund that happened to be focused on value stocks. And what you notice is that had way better performance than anything else. Large US companies, not so great right there, right? Now, how about the next year? Was it the top area? No, it wasn't. Actually, you have international small value stocks was the top area the next year, and international value stocks. So you look at large US stocks, and again, not much going on there. Then you look at the next year after that. Well, it's small value US stocks. And you notice something is something different every time. And you're going, well, rhyme or reason? Not really. Don't know what's going to do well. Then you go to the next period of time, and small US stocks has the best performance in that particular period of time. And I want to bring you to today, from 2015 through 2024, because this is the huge mistake, in my humble opinion, that people are making right now. What they're doing is they're going, well, look at large US companies. I mean, good grief, we're knocking it out of the park. Really great performance over the past 10 years. And to boot, I mean, this is the most familiar area of the market for US investors. What's not to like about putting most of my money right there? So let's say we do that. We end up not being diversified in these other areas that often, as you saw previously, tend to do better. But to look at it a different way, let's look at the last 10 years and look at a mountain chart. Notice right here at the very, very top return, large US stocks, as we just talked about, right? Now, if I'm diversified, where am I? I'm going to be in the middle somewhere here. I'm going to be somewhere in the middle is what my performance would be. And, I'll look at that and go, well, diversification is stupid, right? I mean, gee, we just put all our money in large US companies. But as you saw, that could be a huge mistake. Especially if we go back and look all the way to 1970, you notice that where would I be if I were diversified? I'd be somewhere in the middle right here, right? Because I own all of these areas of the market. Where are large US stocks? They're all the way down here. So you look at that and go, whoa, wow, that could be a huge mistake, really not focusing on diversifying more in the portfolio. Because long run, if we look at these different asset categories, long run, they have respectable rates of return. There are some areas that have higher expected returns than others because they're more risk. But when we put them together, what we know through academic research, we put them together because they don't move with each other. We can have a portfolio with lower risk than the parts. That's absolutely key. Now, if we look at 2000 through 2009, I just want to look at this particular period of time. It's called the dead decade. And what I want you to notice is that there was abysmal performance for large US and large international stocks. As Americans, if we have any international, it tends to be big international companies that we recognize, tends to be what we focus on. So I want you to notice that the return of these two market segments were negative 1% per year and positive 1.5% per year. Now, do you think that mutual fund companies are really diversifying you? The huge mutual fund companies that you see advertised all the time. If they are, we ought to have performance that's somewhere in the middle of all of this, right? Does that make sense? I hope it does. What do we really see? Putnam, Schwab, Vanguard, T. Rowe Price, JP Morgan, Fidelity, Goldman Sachs, Franklin Growth, Principal, and Valak. What's the performance over that period of time, 2000 through 2009? Literally around 1%. The top one was 3 right there. And you look at that and go, whoa, wait a minute. Their performance is exactly what we would have expected based on this chart right here, which tells me that their little bit better performance recently has been really driven by what? It has been driven by their focus on large US companies, which happen to be the better area of the market in the past 10 to 15 years. So watch it. A lot of times when we invest, we can make some of these mistakes and they can have very bad results and they can end up with lower returns, more risk, and a lot more cost. And besides that, it's great, right? No, this is bad stuff. Make sure you're an investor that's informed, because you can get pulled in by a lot of sales pitches that sound really good when they're using just short-term past performance. But diversification is king.